Okay, good morning, everybody. Today, of course, is May 11th, 2017, and our regularly scheduled webinar. So I do want to welcome everybody to the webinar today, and thank you for being here. I want to go over a couple of the charts, starting again, as always, with the monthly now, and just keep highlighting these crucial levels. You know, we're now about 40 points above the upper band on the S&P 500. So we've traded the last few months above it. The composite, same thing. We're at 57.75. The market is closed out at 61.29. So we're well above it on the composite. Obviously the strongest of all the markets. And the Dow, 20,390. So now we're about 500 and change above the upper band on the Dow. And then here's crude. So again, the mid-band's 55.01. We're starting to reverse a little bit this month. You know, I am inclined for another retest at F55. It'll be interesting to see if you can get through it on this shot and see if it holds. Short-term trends have moved bearish on oil. But on this longer-term chart, you can see we're still positive. All right, we're still positive. PPO is still positive. Money flow is positive. So we'll see if it can make a rally back up to the 55 area on the actual spot commodity. Here's the S&P. All right, now 2406.30 to me is the active objective. So I'm kind of happy to see a little bit of a pullback here today because I think that line is still in play. What would negate it would be two closes under 23.98. That would be the line down at 23.75. As you can see from this chart, the S&P has crossed into an uptrend on the 60. We look at the 30, you can't even see the EMAs here, by the way. Actually, you can see the 200. You can't see the mid-band. The mid-band is actually 23.75. So it's right at the next downside, actually the next major support line. But again, it's so far away from the market right now, you can't even see it on this chart. That's why I drew these arrows over here. 23.85 is the 200, 23.75 is the mid-band. And then here's the VIX. Now it's interesting because we are bouncing a bit in the VIX. But the 60-minute chart has moved into a downtrend. Okay, and it's been a downtrend since the first. The major lines, you know, are as is on this chart. So we continue to monitor those major levels. And then here's the 30. You know, similar to the S&P, you can't even see the mid-band. 1193 is the mid-band. 11 is the 200 EMA. So again, strongly downtrending. Now we look at the Qs, and the Qs are very interesting because 138.28 is the confirming line up to 140.63, and we've actually had two closes above that. The last 2 days have actually closed above it. So at this point, 140.60 roughly should be the objective in the QQQs. 137.5 should be support. And I wouldn't expect it to go much further than the downside line, which would be about 70 cents underneath that. Should put it around 136.90, somewhere in that area, somewhere down in here. The diamonds, we've got 210.94 major line. Support line is 209.38, okay? And at this point, we'd have to, actually the 209.38 has been kind of holding as support. And it looks like we're probably testing that today. So this will be very interesting. Oh, and if I go back, here are the upside and downside levels. All right, so the downside level is 210.55. 209.77 is the upside level. The GDX, okay, GDX has crossed into a downtrend on the 60. We are getting a bit of a counter trend rally now. It took out the 2188 line yesterday. 22.27 is the upside level to 23.44. Quite frankly, I wouldn't expect it to go much further than 23.80, somewhere in that area on this rally. So this will be interesting to see if that holds. We look at the 30, and you can see the mid-band, by the way, but if we notice both the 30 and, the mid-band and the 200 are in a decided downtrend. Both sloping down, both exhibiting really nice downtrend formation. Now we go to energy, okay? I felt 68.75 was the target. Yesterday, we came to with, 30 cents of that? And we got the bounce off of XLE, really just above the 65-63 line. Now, obviously, the 200 and the mid-band here are going to be resistance. So we can look at what it's doing live. Here's the 30. Again, the 30 is in a downtrend. But what's kind of interesting about this is the XLE got above the mid-band on the 30. And it's kind of sitting right on that mid-band. And as you can see, the 200 is starting to curl up. So my feeling is if the XLE does cross into an uptrend on the 30, we'll probably see a little more counter trend move to the upside here. I'm not convinced at this point the downtrend is over or the pullback is over in the oil market. Not 100% convinced. So we'll see. Okay. All right, sorry about that. All right, now, I want to look at a couple of the earnings and then go over. Okay, I want to start with steel from last week. This was actually the slide from the last webinar, okay? And you can see steel had gapped down, okay? And by the way, you can see how once it peaked out, kind of petered out around 42, the money flow had flipped to negative, okay? So, you know, there was clearly distribution in this stock even before the earnings. And then, of course, it had the massive gap down. It was down like 26% off earnings. Excuse me. And at that point, what we were looking for, we had the climax volume, you know, huge volume the day of the earnings, over 100 million shares traded hands. Okay. So the question at that point was, all right, where's this thing going to go? And, you know, again, what we were looking for is either a close above the high or a close below the low of that gap bar. Now, as you can see here, here's the low. We kind of had that fake out there the next day, right, trying to suck people in. And then the third day, I should say the second day really, after the earnings, it reversed to the downside and closed out. And of course, proceeded to drift to the downside. So the question is, you know, we see a climax volume, all right, you know, is it prudent to enter the market at that point? All right. Well, you know, in my experience, it's best to just wait a little bit to see where it closes, see if it closes either above the high or it closes below the low. Now, once it closes below the net low, we know there's a very high probability it's going to continue to drift down, and that's what happened. Now, if we scale down even shorter time frame to the 60, we can see the first gap bar, the huge bar to the downside, and then we really didn't close below it until here, right in there. So that bar closed below it. Now, again, we are tremendously oversold vis-a-vis the fact that it's underneath the lower band. But the point here is this. Now we see a bar trigger short, right, To negate this, you'd want to see a bar close above the high. And that never happened. So that kind of told you that it's going to continue down. We got a little couple point move here. Entering on this pullback probably did make a little sense. So you got in around 23. It ultimately dropped to a low of, roughly 21, even 20 down here on the 10th. So it was still about a $3, $3.50 move, which isn't bad. And you can see here on this slide, there's the low. I drew the low in of the first bar. You can see where that bar I pointed out closed underneath the low. And again, we never rallied back to close above the high. And then here's one that just reported the other day, NVIDIA. I mean, this thing just screamed off of earnings, up 18%. All right. What's the dollar amount of that move? $18. Wow. What an incredible move. Here's your daily chart. Here's the huge explosion on the earnings. And then here's the 60-minute chart. So you can see it was kind of consolidating for probably about 10 days prior to earnings. And it just screamed up, took out the upper band, and, it was kind of off to the races. Now, the one thing I want to show is this. In the past, I had shown this using a different ratio. And what I'm specifically talking about is the ratio spread before earnings. Now, this is something I started toying around with to see if this made any sense, okay? Because typically in the past, what I was saying was you do a 2-by-1 ratio, okay? In other words, you would sell 2 in the money calls, you'd buy 4 at the money. Now, again, let's go back to the daily chart here. Yeah, I believe it closed right around 103, so that's why I was using the 103 strike. But then I started looking at this. I said, you know what? Instead of being super aggressive, what if we used a 1.5-by-1 ratio? So in other words, you sell 2 in the money. In this particular case, it's a $5 wide spread. So you're selling 2 of the 98s. They were $7. Now you buy 3 of the 103s, which are virtually the ones at the money. And you can look at the pricing here. All right, the 98, by selling 2, you get the credit of $14. By buying 3, okay, it ends up costing you $12. So you actually end up with a net credit of $2. Now, what makes this particularly interesting is this. We've got a $5 wide spread, okay? We're taking in a $2 credit. So if you think about this, you only really need $300 worth of margin to do this trade, okay? Now, what's our downside? Well, our downside is the stock really doesn't move. Now, if the stock didn't move, okay, obviously these calls are going to completely devalue. And to me, the risk is if it fails, you want to see it fail underneath 98. In other words, if it failed between 98 and 103, that's where you have risk. All right, because you're going to have value in the 98s, which you'd have to buy back. Okay, and you'd have no value really in the 103s. So anyway, by structuring it a little bit differently than the 2-by-1, you end up with a credit. Now, this is what happened post-earnings. Now, again, this was an $18 move, so this is a radical move. But the 98 calls went to 20, the 103s went to 15, okay? So the 2 98s were worth $4,000. The 3 105s were worth $4,500. So you actually ended up with a net credit of $500. on the deal. So to me, it's just a little bit safer than doing the 2-by-1, because if we go back to this slide, think about it. Say we sold 2 and we bought 4, okay? Well, at that point, you're actually coming $2 out of pocket. So your credit would be, it wouldn't be a $2 credit, it would be a $2 debit. So it would cost you $200 to do that trade. Now, say we added one more call on the long side. Well, what would happen is you'd have a $2,000 profit versus a $500 profit, okay, because you're adding one more. But think about it. You're going into the trade with a $200 credit versus costing you $200. So to me, if you looked at this and said, you know, what would you rather do? Well, you know what? I'm a little more conservative. I'd rather do the 1.5-by-1, if that makes any sense. You know, because what would happen here is, say you have a 10 lot, well, you're actually making $2,000 to put that trade on. When you close it out, you pick up $500, actually $5,000 on a 10 lot. So to me, this is a little bit more interesting a setup. Now, here's where it gets really sexy. What if you put on the 1.5-by-1 on the put side at the same time before earnings, right? Say you pick up a $200 credit on the put side. Well, when NVIDIA exploded, you'd be, you know, assuming you did a 10 lot. When NVIDIA exploded, you'd pick up another $2,000 in the form of the credit on the put side. And I'm assuming that, you know, you're picking up roughly the same credit on the put side as you would the call side. So, you know, those options expire worthless. You know, they're gone, all right? And you've collected the full credit on that. So if you think about it, if you did a 10 lot in either direction, you're walking away with about $7,000, okay? And then your margin on that would be roughly $6,000. So it's a really sweet return. And, you know, I don't know. To me, it's a little bit more conservative than doing the 2-by-1s. Anyway, that's what I wanted to cover today. Then I wanted to go into some of the live markets. Any questions on any of the charts on the PowerPoint? If not, I'll close down this. I'll close down the PowerPoint. Yeah, this. I started finagling with the numbers because, you know, I was looking at this and I'm saying, you know, when I always looked at this, I looked at it like, okay, let's do a 2-by-1. And obviously on a radical move, you make more money, but not all the time can you put on that 2-by-1 at a break even. So then when I started playing around with the 1.5-to-1, I said, wait a second. You're still getting the benefit of the appreciation, but you're actually getting paid to put that trade on. Now, I will say this. I priced it out for Priceline. Now, we know Priceline had an exorbitant move here as well. Let me put up the chart. All right. Priceline was down, what, something like $80 off their earnings. Now, when I priced out Priceline, doing the same concept, all right, you actually lost money. Take a look here. Yeah, you actually lost money. And the reason for that is that the Priceline options are really relatively thinly traded versus a NVIDIA, which is a lot more active. So, I mean, as a general rule of thumb, I wouldn't necessarily be looking at this on some of these, you know, really wide bid-ask spread deals that are thinly traded. And quite frankly, because I think, let me take a look at the numbers if I have it. Yeah, The 1910 put on Priceline was actually $41. The 1900 put was 35. So you were actually, if you did a 3x2, it actually cost you $2,300. And then when you unraveled it, you lost $3,600. So I mean, and again, that's because the option prices on Priceline are really out of skew. But I bet you on Snapchat today, if you use the 1.5 to 1, you probably walked away doing pretty well. Look at that, down 19% today. And by the way, the retailers are getting slaughtered again. DDS reported is down huge, and Kohl's too. Kohl's is down, well, only about 5%, not as much. But JWN does report tomorrow. All right, so they're down almost 8% today based upon the sympathy trade with these other retailers. Retailers look like they're going out of business. And it's funny, I was looking at some of the let's see, some of the most actives today. And what was interesting was RH reported, which I didn't see. And they were down at one point, like, I don't know, today's low was 52. They closed about 60, so they were down. But I thought this was interesting because, you know, Restoration Hardware had been up above the upper band, and money flow would flip to negative. Oh, good. Nice, Andrew. He closed it for a double. Let's take a look here. Wow, that's a nice bounce. And there we go. There's our perfect setup, by the way. 30-minute uptrend, money flow positive, diamonds sitting right there at the lower band, and they bounced. And I think the target is back to 209.34. So that was nice. That's a really nice trade. And that's kind of a no-brainer, by the way. In at 1050, out at 1220 on a double. That's awesome. Great trade. But it's remarkable how that darn setup works fairly consistently. Now, can you imagine if that were tomorrow? What did you pay for the call, if you don't mind me asking, Andrew? And I'm trying to think in my head how much it would be if this were Friday. 36 cents. Okay, so on a Friday, that might have been a quarter. Unbelievable. Out at 75. That's beautiful. And yeah, I mentioned John. He put on Tesla yesterday. And you know, look at that. Tesla really didn't even move yesterday. I mean, it was just kind of choppy all day. And I think he was in around 675, got out at like 950, so he made about 50% too. But this was the thing I wanted to show on Tesla, which really irritates me because I thoroughly missed it. This was the earnings, okay? Let's put up a 62. There's the 60, okay? They had the earnings here. dropped down, stopped right at the 200 on the 60, which happened to be the lower band on the 30, okay? And look at that. Ever since then, right, it's been pretty much straight up. And I think the target's up to 330, which is the upper band. And quite frankly, I missed it. I missed the whole concept of trading this, which really irritates me. But if we look here at the daily, right, it had been above the upper band. The Chaikin money flow really just slightly turned negative on the daily. For argument's sake, it was pretty much positive the whole way. But here's the thing I wanted to point out. Here's Friday. We had the gap up on Friday. Okay. Monday, we have another gap up. So we had a gap up following a gap up, gapped up above the mid-band. Look at how it came back, the whole support of the mid-band. And since that point, it's been pretty much uphill. So this was a relatively low-risk trade because of the entry point here. But we look here, the mid-band is about 307. So even if you got in around the mid-band and went from 307 to a peak of 326, I don't know if that hit today. Yeah, I guess that hit this morning. So that's even a nice trade. Ooh. Let's take a look at this. Oh, yeah. Yeah, they reported. Didn't they report? Yeah, they reported Tuesday after the close. All right, so there's the gap down. But you should still be, I don't know what strike you have. You probably aren't really even down. Now you're fighting premium erosion. But I still think Disney's target's back up to 110, 111, back to probably test the mid-band, which is probably about half the gap. But that's a good trade, too. Now, let's look at Disney. But you're right. I would have taken profits on the gap up. Let's see Disney here. That's not what we want to see. All right, there's Disney. Now, it's interesting because even though the trend is bearish on the 30, the money flow is still positive. So I would think this thing would continue up. You know, because this morning, it had the retest of the lower band. So I think at this point it's probably going to continue to move up. Interesting. Was there any others that, let me see here. What did we have? Well, the other really big move was Fossil this week. All right, so Fossil gap down is well below the lower band. This was a pretty big percentage-wise, like a 20% drop. But I don't particularly like any of these retailers at this point. You know, I wouldn't even be tempted on this. You know, maybe if it started to show a little bit of strength, but it's really not. And that's crossed up on the 30. Price line, it's funny, I looked at it before the webinar. It came back down and took out the mid-band on the 30. So my feeling is it probably has a little bit more down, and it's not showing a lot of conviction at this point. All right, well, now this gets interesting. All right, it's sitting right at the mid-band on the 60. 1798 is the mid-band. Because I don't like when it breaks support here. But 1798, 1799, call it 1800 is the mid-band on the 60. Now, this could actually be interesting. Could be interesting because, you can almost trade this thinking that 1800 is going to hold. If 1800 doesn't hold, you get out. But you see, if I were long price line then, you'd want to be watching that 1825 level. Because I would expect at that point that the 30 would give it some resistance. Let me see if anything else. Timex, snack. Oh, Macy's was, what did Macy's do? Wow. Macy's is down 14%. Wow. All these retailers are just getting hammered. Teva. This is one I've been looking at to see if it's possibly bottomed. I mean, granted, it looks very extremely bearish there. But let's look at the weekly. Look at the weekly. I mean, just completely negative here. But it's kind of gone sideways. So, I'm looking at Teva here, or Teva, however they pronounce it, as a possible turnaround trade. And they did have a slight beat, so that's kind of interesting. Let's look at the 10. Let's see what happened. ATHM. Oh, gosh. That's funny, Andrew. I'm going to read this. Andrew said Macy's. The last time he was in Macy's, it did not really look like a premium retailer. Trash on the floor, dirty carpets, and ignored by the salespeople. You know what's funny? The reason I kind of chuckle about that comment is I could probably say the same thing about Sears. All of that applies to Sears. It's amazing how Sears is just such a dinosaur. Kind of sad. I mean, it's Crocs. Wow, a retailer that was up. Wow, soda. Kind of sad, by the way, with Sears, because I don't know if you guys are old enough to remember. I want to look at one other, this WAC. But I remember as a kid, the biggest thing in your life as a child going into Christmas was, the arrival of the Sears catalog. They'd send this big, huge, thick catalog full of toys, and I just remember my siblings and I would just sit down and go through it and look and say, okay, yeah, I want that, I want this. That's how you got your Christmas list. They don't even do that anymore. It'd be way, way too expensive. I mean, these things were monstrous. Yeah, I did want to show that GMO. I couldn't believe this move. All right. They had reported, okay, here's the report date. You can see money flow had been slightly positive. Here's the 60-minute. Okay, took what, 1, 2, 3. Basically on the fourth day it started to break out, closed back above the lower band. And look at this move. It was up like $12 in like a couple of days. Just amazing. I might stand corrected. It's just not a stock that I really even look at, but all of a sudden it's getting a lot of ink. Okay, so this was the 27th they reported. Okay, so they reported here, they had the drop. And then what's kind of interesting about this chart here is that the money flow quickly switched to positive on the 60-minute chart. The daily, that kind of remained positive. And look at that move. It just took off. Just amazing move. So that's one definitely you want to look at in the future for earnings, because quite frankly, I never even heard of that company. And this is one that had reported. This Grainger. And I keep looking at this Grainger, by the way, because it's an interesting chart to me, because they got above the upper band, sold off. Basically was a $260 stock and is now $186. So it's down, what, $60, $74 in a couple of months. And voila, it's sitting right at the lower band. So this is kind of an interesting look to me, and it's definitely starting to firm up a little bit. I looked at some longer-term options on this, but they were really thinly traded, which always upsets me, by the way. Yeah, I don't know if there's anything else. If anybody wants to look at anything while we're on the webinar, we'll take a look. If not, that's pretty much what I wanted to cover today. All right, now look at that. Diamonds are kind of consolidating. And probably going to make a little punch up. And there's your fix. It's been really interesting this week because oh, absolutely. You got to double, you got to run. But this has been kind of interesting because we have a shorter-term support level right around the 2392, and of course we've got 2398 as the downside level, and the S&P is pretty much traded between those levels. Okay, pretty much all week, and then finally, we're getting a little movement here. I'm still biased for the 2406 level to get hit. All right. And obviously it looks like it's kind of weakening a little bit, but I'm still biased for that objective to get hit. I mean, I can't recall when an upside confirming line did not get achieved after being confirmed. It's been a long time. So look at today's price action, right? We opened at 23.95 roughly. Sold all the way down about 14 points, and now we're almost back to the open. So, I mean, I think the point here is that, you know, again, we know the 30 and 60 are up, okay? The question is, you know, where will support come in? A little bit clearer. I think this is a better trade because, look at that. It stopped right at the bottom band. The S&P didn't. So you might have been looking at it and going, ah, geez, you know, maybe it'll, drop even further. Yeah, and the SPY didn't either. I just want to look at FireEye. All right, you know what, FireEye, I want to see where this ends up closing today because I may recommend we sell some calls. I probably should have suggested that already, but it hit the almost 15 real quick today. You can see it didn't really hold that level. All right. Well, good. I think that's pretty much what I wanted to cover today. Yeah, you know what I'm going to do is develop a spreadsheet for the 1.5 by 1 ratio back spreads pre-earning. And, you know, go in, we can project out obviously what the market maker's move is and then price out the options. Because to me, it seems that if the market makers move, you know, if the option, how do I say, if the option pricing is less than the projected market maker's move, it's probably well worth the risk. And that's what was kind of funny. I looked at the projected move on NVIDIA, and I said, well, you know what? This seems like a reasonable risk. And, of course, it actually exceeded that. So of course, anytime you exceed the projected move, it's only a better trade. But the thing I like about that structure is you're getting paid the credit going in as opposed to laying out money to put that trade on. All right, any questions before I close down? Awesome trade, by the way, Andrew. Great job. Nice to pick up a quick double in about an hour. That's really a nice, you know, that's a nice trade. Yeah, well, the problem with Priceline is, like I said, it was too illiquid to be able to get a credit on a 1.5 by 1. And I think that's the nice thing about this, because say you price out that structure going into earnings. If you don't get a credit or even a break even on the trade, you probably should avoid the trade. That to me is a nice feature about that structure. Now tonight we really don't have anything reporting. I mean, I guess JWN is about the only one that could have some consequence. But, you know, I might price that out and see how that would do, and then maybe the next webinar we'll look at it. All right. Well, anyway, listen, I want to thank you all for being here. And again, wish you a great rest of the week. And Andrew, hopefully tomorrow we'll get a couple of these moves. Have a nice day, everyone. Thank you.